So this is a economics panel, one of my favorite topics, and these are honestly some of the smartest people that I know. So, I've tried to really gather people that are friends, but also what's going to create. Somebody mentioned that, hey, I've been to a lot of conferences, and just people come up and pitch things the whole time. Ever been to a conference like that, right? Where they just kind of pitch another thing. We're trying to create value for you. So when you look at your investment portfolio and you look at what you're doing, you're actually informed to make better decisions. Does that sound like a good plan, right? And these people aren't going to try to upsell you or do something later. We're just trying to give you the value. And all of these people are just incredible. We've got their bios are actually on the website as well. We're going to hear a little bit later from Mark as well. Mark is an awesome guy, so he's going to be speaking later this afternoon. One of the smart, well, anyway, you guys are all super smart, but just, you guys are all amazing. I can't say anything else, but you see Mark as well. So let's go down the line. Start with Jeremy, and just maybe give a 30-second introduction. This is who I am, this is what I do, and so people can get to know you.
All right, thank you for having me here. Guys, thanks for being here, appreciate it. My name's Jeremy Roll. I've been a limited partner or passive investor in syndications since 2002 and full-time since 2007. So it's been a while. Went through the last downturn, in the middle of going through this downturn. Actually really looking forward to everyone else has to say about macroeconomics. So thank you for having me.
Good to have you, Jeremy. Thank you. Christina.
Same thing. Thank you, Bronson, for inviting me. It's wonderful to be here, and thank you, guys. So I've been a real estate investor for about 35 years. I started when I was 2 months old. Okay. It's such an old joke, and yet people still laugh. It's so good. Thank you, guys. No, I appreciate it. So I have lived through the 2009 downturn. I got particularly excited about economics when I realized that I wasn't the smartest person in the room or the smartest person running my own portfolio, and discovered that economics was really going to make the decision for me. And so it was a humbling experience, but it really taught me to dig in. All ships rise and fall on the tide. So since then, I now have a diversified portfolio between stocks, which I also lived through the dot-com bust. So between stocks, real estate investing, hard money loans, and some syndications, and some few doors that I own directly. I'm more of an older investor, much more interested in being passive. I'm also a real estate investment advisor, so I discuss real estate all day long. I run 2 real estate investment meetings, ITI, which you see here, and FIBI Pasadena. And I'm also a registered investment advisor with looking to get assets under management.
And Christina and I co-lead that meetup in Glendale, Investor to Investor, which we'll share more about later, but we do that once a month in Glendale. So
we do.
It's awesome, yes. Okay, Mark.
So I didn't start investing when I was 3 months old.
You
I started a little bit later. But no, right out of I'm from Southern California, right out of high school, 1995, coming out of the sort of first real estate crash we had in California from 89 to 92. The banks were sitting on tons of bank-owned repos. They didn't know what to do with them. I'm fresh out of high school. I don't know what I'm doing. 1995, I saw some people buying these properties from the banks at zero down. Seemed like a pretty good idea, and I bought one. I got a VA repo, zero down from the bank. It was an $80,000 property. I had to scrape together $3,000 for closing costs. Had to bring out a partner. Made 30 grand on the deal, and I was off to the races. Managed to parlay that over a decade into multi-8-figure portfolio. And a couple businesses along the way, some big exits, and then 2008 came and wiped me out. I thought I was super smart, and if you guys know, Southern California real estate got hit super, super hard. And it made me realize, like, dang, like, what the heck just happened? I'm pretty smart. I made a bunch of money in business and real estate, but what is this whole financial casino, this Fed market? What is this bond market, fiat money system? I don't know anything about that, but it has a lot of control over my life. And so I had to, dust myself off and get going again. And I vowed to myself and my family that it was never happen to me again. And so I've spent the last 12 years studying the macroeconomic landscape because whether you like it or not, I like to say that the ostrich can bury its head in the sand, but it won't keep it from getting eaten. So you can choose to ignore it if you want, but only at your own peril. So I spend a lot of time focusing on that. I make a lot of content, I have a radio show, a YouTube podcast, talking about macroeconomic stuff. I'm still a real estate investor. I got back on that horse as well, and just trying to help people make or avoid making the same mistake I did.
Thanks.
Neal Bawa. I'm a technologist, a data scientist, and I'm constantly terrified by how little what I and other people in real estate do that matters compared to the force of macroeconomics that controls an astonishing percentage of everything that we do.
So I wanted to share this for you. For those that don't feel like, maybe they found a little like intimidated by macroeconomics, or like you didn't really, kind of like Econ 101, supply and demand, like it's there somewhere in my brain, but I don't know exactly what this has to do with anything. Well, Mark kind of alluded to it, right? If you were only a real estate investor and you were only paying attention to real estate, what happened in 2008? There were macroeconomic forces that just wiped people out. And your story is not unusual. There's a lot of people, probably even in this room as well. And so we pay a lot of attention to what's happening, what the Fed is doing, what other kind of assets are out there, what's happening with interest rates, because this all affects how your real estate, how your other investing is going to do. So that's why this is the Advanced Real Estate Investing Summit. This is, not 101. This might be 201, 301, 4. We're going to go a couple steps above. If there's something you don't understand, I was sitting by somebody and they were taking notes. If there's a term you hear that you don't understand, take a note on it and look it up, or ask one of the speakers about it later, right? Because we're going to talk about some stuff that we're going to get into it. So let's talk about that. Let's just kind of go down the line here. I want to see for each of you, because I know each of you have sources that you're looking at, ways, indicators you're trying to say, okay, what's really happening right now in the economy? And what are some indicators that you watch and that you've noticed are maybe alarms that have started tipping off, or just things that you're watching and new developments in the economic landscape? And we start with you, Jeremy, without putting you on the spot.
Yeah, no problem. So, it's funny. You're asking me what I'm seeing unfolding right now, but my answer is I actually saw it unfolding a long time ago. And not because I'm smart or whatever, it's more like there's a lot of indicators that come up that you can follow that can give you a lot of signal. And so I know Neal was talking about some of the carnage that happened in the past couple years. Like, I did not invest in one floating rate bridge loan apartment deal, for example. And there's a reason why I didn't do that, and that was based on economic forces and what the cycle looked like and when we were probably going to have a downturn. And so I could not agree with what you guys were saying before more about the force of economics and not taking that into account. But the more important piece of that is actually trying to figure it out as far in advance as possible, right? And so I'll give everybody an example in the room. How many people here, actually, with show of hands if you don't mind, would agree that if you bought a property even this year or next year, and your business plan was to flip it in 3 to 5 years, you're probably going to do well? Okay, that is fascinating to me. That is not all what I expected, because the value add, which is what we're talking about, and doing a short-term deal works best at the beginning of a cycle, but is the most risky at the end of a cycle. But as investors, we're all presented with value add deals at the end of a cycle because you're going to hit that 15 IRR in the projections, and that's the most risky time to do it. The least risky time to deal I just gave you an example of is exactly at this time and next year, because you have 3 to 5 years of runway where things are going to get better. And you're going to have forces, He did not pay me to say this, by the way.
Except for those cycles. Except for those cycles are all broken. So
Yes.
Okay,
there's
well, we
that.
can get
Okay,
into
the
that.
cycles
We can
are
get
broken.
into
We can
that.
talk into
into
that.
So
We
there's
can
all
get
We
into
can
that.
get into
that.
that.
So my very long answer, I'm sorry, is that
I wanna hear
it's really critical to understand the indicators and the ones that can give you the most amount of advance notice. And I'll give you one quick example, and then I'll stop, which is we were just talking, Christina and I, before coming up here. We're talking about the job market. You guys have probably been reading in the media how strong the job market's been. It's been unusually strong. But if you look at the real data and get out of the weeds of the media, you will see that from the month that the Fed starts to raise rates until the average time that the jobs market starts to get worse is 18 months, which is September. So when I'm looking at these headlines saying, oh my God, in June, the job market's so strong, there's not going to be a recession, I'm like, no, we're not even at the average time at which the unemployment rate should start to go up yet. And so that's a lot of notice you can get, but you have to study the economics of it and look at the past cycles and be able to then, from a probability perspective, take all this data and apply as much as you can going forward. So my very long answer is there's a lot of stuff that you could have looked at even 18 months ago. Inverted yield curve, job market, leading economic indicators tell us that there's a chance we're already in a recession. All these things, and they're forward-looking and, from a long time ago type of things. That's very critical.
That's great.
Sorry for the long answer.
That's good. No, there's a lot to talk about here.
To me, that's a really good answer, because to me, I'm constantly looking at charts. I believe that charts are the ones that are going to tell me what happened in the past. It gives me some idea of what might be happening in the future. Mark is going to be free to counteract me here in just a moment. Might be happening in the future. But there is indicators like the yield curve, which reversed quite some time ago. Generally 18 months after the yield curve first reverses, that's when you start seeing a downturn. Let's see, 10 out of the last 13 times the Fed has increased the discount rate, we've seen a recession within anywhere from 6 to 18 months, generally closer to 18 months. And by the way, 2 of those quote unquote times they increased interest rates and they didn't have a recession, they continued to increase rates. They took rates, they paused, they increased rates until they created a recession. So I feel like the Fed generally is not stating it, but is intending to create a recession. That is part of how they put the brakes on the economy. And we're already seeing that inflation has gone down. We're already seeing consumer confidence going down. We're already seeing the PPI going down. We're already seeing unemployment is increasing. So we're already seeing a lot of things are moving. And GDP has gone down even though it hasn't gone negative. So we're seeing, and inflation's gone down. So we're seeing that there are many charts that are saying, yeah, we're down, we're down, we're down, we're down, over suggesting a negative direction. Now, what I like to add to Jeremy's comment is also news on the street. I run 2 clubs. I'm constantly asking people, so what's going on? What's happening? And I'm getting phone calls from people because they perceive me as somebody who's in the industry. And we talked about this last time, Jeremy, you and I were on a panel. I know of at least 6 deals right now that are in the multifamily market that are failing. They're going to, and probably at least 3 of them are going to fail completely and lose all their investor equity. At least 3 of them. The other 3 might be able to be turned around. And I'm just one little person. Jeremy, you said that you've been receiving the same phone calls.
Yeah.
Of multifamily. So we're in it. Now that doesn't mean, to support Neal, that doesn't mean we should all freak out, unless of course you're in a deal that is failing, and then you have to deal with that. I get it, and I'm not saying you shouldn't. And I've been there. Right? It was in 2009. I've been the loser. I've done it. I understand. But there is a window here that is opening up. And there's a lot of money on the sidelines ready to take advantage of the window that is opening up. It helps if you think about it being like waves coming in and out on the sand. This is not personal to you. You didn't create this. You aren't responsible for it. But you can be a positive reaction to it. You can choose to be aware of it, present to it, and choose to understand what it's telling you versus being in an emotional state about it. And so we're going to have a window that's opening up here that we as investors want to track and want to be engaged with. Okay, that's my spiel. Mark.
So this is going to be a fun panel because I'm going to take the opposite of all that.
Go for it. I love it.
That's why I love panels, because you get
That's
like
right. That's why we
different,
got panels.
A couple of things that were said there. So sometimes you have to, what do we call it, look through the trees to see the forest or whatever, forest of the trees, right? And so like, sure, yield curve, it's inverted. Cool. Average 18 months, we have recession. Really? The average. Okay, so I have a video on my YouTube channel, Mark Moss. I broke all this down. I went through every single yield curve. I measured from the beginning to the end, and it averages from 6 months to 54 months. So should we take the average? Because it could be 5 years. So we just take the average? So there's a couple ways we can look at this. We could look at let's look at from when the Fed pauses. That's probably a little bit more accurate.
Yeah, I like that data.
But why the pause? The Fed just raised rates at the fastest rate in history. Mm-hmm. So maybe we should actually go back to when the Fed starts to raise rates, not pause. That's interesting. So we can get all kinds of data. But let me ask you another question. Why does it matter? A recession is going to come. The yield curve, to Jeremy's point, he's absolutely accurate. When the yield curve inverts, every single time is spelled recession, typically 18 months afterwards, yes. It's not when the yield curve inverts, it's when the yield curve uninverts, by the way, which it's about to do. And it's inverting on the wrong end, which is another strange phenomenon, which I'll talk about in my talk later. So stay tuned for that. But back to the recession. Why do we care? Why do we care about the recession? You guys are multifamily investors, which means you're buying apartments, which are low-income housing. Did anybody invest through 2008 like I did? Not very many people. So you're not old enough to remember. Hopefully, if you studied your history. What happened to rents in 2009 and 10, 11? They went up.
They went up.
Oh, they went up. So as multifamily investors, maybe a recession is actually better for us. Now, to Jeremy's point about where we are in the cycle, if you wanted to buy a building a year or two ago and you're hoping to sell it next year, that's going to be a problem. So the first thing you have to ask is, like, what problem am I even trying to solve? If I want to have a building that continues to have good, strong growth trends in the rent rolls, recession is probably going to be pretty good. No one can afford to buy a friggin' house. They're going to rent. That's really good. Now, if I'm trying to fix and flip and it catches me in the wrong cycle, that's bad. So first you have to understand what problem I'm trying to solve. Now, you mentioned these investors, multifamily investors, are getting caught off sides right now. We're hearing stories of people giving their keys back to the bank and things like that. That's because they got caught off guard by the rates. Mm-hmm. And this is the point that I want to bring up to. Sure, we can talk about economic data, we can look at unemployment data, we can look at consumer credit going through the roof while savings is plummeting, we can look at all that data, sure. We can look at the yield curve and recession and whatever. Does anybody remember what happened in 2020? It wasn't that long ago. The entire economy was literally shut down, like businesses were forced down, but asset prices went through the roof. So we saw that the economy and the markets no longer equal each other. So if I care about asset prices, I don't care about the friggin' economy. If I care about the price, the value of my building, and I care about the rent rolls, I don't really care about the economy. I'm looking at something different. What am I looking at? So what I'm looking at in regards to this, and maybe we're trying to solve different problems, but I want to know where the liquidity is going to be. The Fed is in a tightening cycle right now. So Jeremy talked about cycles. They're in a tightening cycle. They're shrinking the amount of money that's floating around. When the money supply increases, prices go up, things are good. When the money supply shrinks, things tighten. So they're currently in a tightening cycle, so they raised rates to tighten things. A lot of these Johnny-come-lately syndicators got caught off guard because rates went up. And not just them, all the banks did too. We saw the banks collapsing because of the same thing. They got caught off guard by this rate increase. So we want to understand rates. So I'm looking at what is the Fed going to do? Remember, I told you my story. I got caught off sides because I wasn't watching the macro, what the Fed's doing. So that's what I'm paying attention to right now. I watched the Fed meeting yesterday, and if you didn't hear what Jay Powell said yesterday, then you're not going to be prepared for what's happening. I also did another video just a week or two ago, and I talked about the difference of how the Fed and other central banks intervene in the markets and how it's changed since 2008 through today. So you have to understand that, because if you're just thinking that whatever happened in 2008 is going to happen again, no. As Einstein said, the answers have changed. We're in a completely different paradigm that you have to shift. We'll get into that, but I'll just end it by saying, so I think what I'm watching for, and again, depends on what problem you're solving, but I'm paying attention to the money supply, and I'm looking at what the Fed interest rates are doing, and I'm looking at what's inevitable for the Fed to do, because their hand is going to be forced into action.
Nice.
Nice.
Thanks, Mark.
I'm succinct. So I love what Mark said, and I want to piggyback on a few of those things. The first thing I wanted to talk about is that any look back at history is going to lead you in the wrong direction at this point. The Federal Reserve since World War II has raised rates 9 times. They put us into a recession 8 times. And by the way, pretty much all of those recessions were shallow, because the Fed's job is to force us into a recession, and then the Fed's job is to take us out, right? And they do both jobs. They either don't, you can't say they only do one of them, right?
It's not supposed to be their job, but they are doing it.
They have no choice at that point,
That is the
right?
tool they use.
They have no choice. So unfortunately, our economy is on a cocaine drip. The Fed's in charge of supplying the cocaine. So, and so this 9th time, by the way, it's only statistically a miss. The truth was they brought us extraordinarily close to a recession, and that was just accidental. It was 0.1% growth, just a recession, right? When I look back at the data, what strikes me is what's different this time is $31 trillion of debt.
33 now.
$33
You can't
trillion
keep up.
dollars of debt. $34 trillion of debt.
$2 trillion in just the last few months.
It's just ridiculous, right?
Yeah.
What I'm trying to point out is, what was different even in 2008 is that when the Federal Reserve eventually raises rates, right, that obviously impacts how much we have to pay, the government has to pay in interest on its debt. And the debt has so ridiculously increased in the last 15 years that back then, that increase in interest rates was something that we could sustain, because we bring in $3.5 trillion a year in total tax receipts, and that's, from individuals and corporates, $3.5 trillion. Back then, if the Fed increased rates, let's say in the 80s or 70s, and we had to pay $50 billion more in interest, no freaking big deal. It's $3.5 trillion. Back then it was $2 trillion, but still no freaking big deal. Today, with $33 trillion in debt, if the cost of your debt, treasuries, increases by 1%, then $330 billion of your $3.5 trillion vanishes into thin air. into thin air. Where does that money come from? Well, it can come either from the Pentagon or from entitlements. That's the problem that we have. So one of the key things that I'm saying is different this time is there is no history of Congress interfering with the mandate of the Fed. They do not interfere. This is one of the great strengths of this country. We are at the end of that process. I forecast that in the next 2 years, Congress will increasingly interfere with the Fed because the Fed says, my job is price stability, right? Not high inflation, and job growth. Well, the problem is, sometimes when I want to drive price stability, I'm going to jack up rent. I'm going to jack up inflation to do that. Well, the moment you do that, even for a single year, on $33 billion of debt, luckily not all of them are one-year treasuries. Some of them are 10-year treasuries,
Right.
so they're not quite affected yet. But as we roll over these treasuries, I am seeing what is happening to our interest. This is insane. What is happening here is hundreds of billions of dollars that were going to people and into the country are now going into interest. And the problem is, these are 10-year treasuries, right? So for 10 years, they're going to have high interest rates. This is fundamentally different. It is a unicorn moment in this country, which I believe means that the Congress, which is a bunch of numbnuts when it comes to economics, is going to
Yes.
start interfering with the
Yes.
Fed, which actually knows what they're doing. And I'm terrified with that process, and I don't know how it's going to play out, but Congress will try and force ever lower interest rates because that's the only way they can do their favorite activity of all, spend money without thinking about where it comes from.
And get reelected.
Let me jump in real quick. I agree with like 80% of that, but there's a couple of things that were
The panel's getting good, guys. The panel's
that
getting
really
good.
need to be discussed here.
You
Okay?
don't have any questions,
So-
right? Because we're just going to be
No, I'm
discussing.
just, well, no, this is great. I love it.
Well, I think we should address this.
Well, no,
I can
think-
wait.
No,
I
go,
want you to
go.
address. But what I say is, this is really good because you'll get very smart people in the room, and they'll have differences of opinion on things, and so you'll have to make your own decision on what you feel fits, right? So that's why I love this kind of debate because I have tremendous respect for all of you, and especially you guys that there's something you disagree on. So let's go into it. Let's do it. Yeah.
So I agree with pretty much everything that he said, except for a couple things that are kind of important. So one, the government and the Fed have actually joined up a couple of times throughout history. So this wouldn't be unprecedented for them to sort of work together. We've seen it since the Civil War. We've seen it in the 40s and 50s after World War II. And so we've seen this before. The other thing that I would say is also we actually have seen this level of debt before as well. So what happens is most of us just haven't been alive long enough, right? So most people say, oh, it's sort of like the 70s, the 80s, high inflation, embargo, blah, blah, blah. No. It's really more about where we were in World War II. So we had these high debt to GDP numbers back then, and there was a specific playbook that they used to get us out of this. The IMF published a paper in 2015 called The Liquidation of Government Debt, where they spell it out exactly. It'll be most likely the playbook that they'll use again. So we have seen this level of debt to GDP before. We also have seen the Fed and the government working together before. And I would agree, we are going to see it again. The other thing where I strongly disagree is, no, the Fed has no idea what they're freaking doing. Jerome Powell and everyone else at the Fed's a freaking idiot.
Compared to Congress. Compared to Congress.
Let me tell you,
Compared to Congress.
They're geniuses compared to Congress.
Well,
Now that
they're a genius compared to Congress because they actually care about preserving the role of the dollar, whereas Congress
Yes.
just wants to spend and they don't care about the dollar. But Jerome Powell and everyone else at the Fed are a bunch of friggin' idiots, and I say that in the highest regard because anybody that would take that role thinking that they can control a market like this is an idiot, right? A market is made up of billions of people. You can't run it like a machine or like an engine. Okay? So anybody that would take that role is sort of an idiot. They don't really understand how things work, complex systems. That being said, anyway, I'll pass it down.
That's okay.
Yeah.
Well,
okay.
you go ahead.
Well, okay. Let's have a quick response from you two, and then I want to get into what does it mean for investors, and then we're going to do a few questions. And I
That's
know
the one area we might
this is
agree.
actually
What
going to
does it
be a
mean for
3-hour
investors?
panel. Do you guys have 3 hours? We're going to say. I'm kidding. So let's go, Christina, and then.
I agree with 80% of what he says and 70%. No, I agree. This is actually not a simple this is not a simple economy. The economy of the United States is not simple in any way, shape, or form. There are a lot of things that are moving inside of it. The Fed has a limited number of tools available to it: interest rates, quantitative easing, and being able to. I just forgot the third tool. All right. The two that we've seen them use is interest rates and quantitative easing. And so they're doing what they're doing with the tools they actually have access to. And the recessionary tool is just a tool. It's like they got a hammer. They've kind of got one tool. It's a hammer. And they're going to do this, and this is how they're going to manage it. And I don't know that we're going to see the politicians and Congress support what they're doing. Because, I mean, they just passed where you can buy 4 units or less at a much lower down payment.
That was pressure from Congress on Fannie Mae to say, you need to maintain price stability in the multifamily market. And we don't care. We don't care if you start giving away mortgages at 5% down.
And it's 4 units or less. And I'm like, why are they doing this? Are they not aware of what's going on? They're idiots, right? 4 units or less isn't going to make a difference. That's not where the biggest bath is going to be happening, but that's what they did. So I personally do think that they're not going to work together in harmony, not necessarily completely fighting it out in the streets, but I'm not sure that they're not going to be at odds, which is part of how we got here to begin with. Right? With the Congress and wanting to hand out a lot of cash and being able to do that. And now we're trying to increase interest rates to be able to bring more stability to a market that's been hyper-fed, not commenting on right or wrong. So don't have a conversation with me about right or wrong. That's not what I'm trying to do. I'm just trying to say that there's been a lot of movements that are going on. And I don't know, I can't say, is this recession going to be shallow or is it going to be deep? Because I'm still waiting for a lot more actions from those 2 governing bodies that are out there.
Thank you. Jeremy.
Okay, I'll try to keep it short. I promise.
How much do you agree with?
That's
Yeah,
always
let's
tough
do
on
percentages.
economics.
Run
I would
percentages.
say-
Run the percentages.
I agreed with about 90% of what Christina
Oh,
said.
wow.
And I've known her for a long
0%
time.
of her.
And probably about 25 to 75%
We need to
of
start
what those
keeping
guys
track of
said.
this on a whiteboard.
But I'm going to keep it short. I'm going
We
to.
need a scoreboard, Bronson.
Scoreboard.
Yeah.
Scoreboard.
So-
It's like a popularity contest. We're gonna vote at the end who's right,
But I do want to make 2 important points. Number one is some of what I was trying to touch on before when I started before was that personally what I do as an investor is I'm trying to avoid the landmines, and I tend to be a longer-term, more predictable cash flow investor. That's my focus. And you have to think way ahead to avoid the landmines. That's very, very important. And for whatever's been said, my personal opinion is that you can take a look at history and apply probabilities to and try to navigate the waters with the highest probability scenarios. It's never necessarily going to be 100%. None of us know what's going to happen next year for sure. It's impossible. But I tend to work with probabilities, and those probabilities are telling us certain things, and have told us certain things for a long time now, which is kind of my point before you can go back and apply those probabilities. One thing I do want to point out, though, it's a bit of a different opinion to what Mark has said on the apartment side. In 2008 and 9, I lived through it, I invested through it. The reason why apartment rents went up is because we had a ton of single-family foreclosures. People had somewhere to have to live. So all the investors knew that the number one asset in demand was going to be apartments. It was very obvious. We all knew it. Everyone was getting foreclosed on our single-family homes. Yeah. So I would caution you, and I'm saying this because there's a lot of multifamily investors in the room. In recession, it's not necessarily the case that rents go up, right? And in fact, what I call the recession playbook for rents, and this applies across all asset classes, is that economic activity slows down, people lose jobs. Vacancies go up, rents go down, right? In many cases, like right now, expenses continue to go up, your net operating income comes down, but you have to expect as a typical recession playbook for rents to go down, including multifamily, on average, taking history and extrapolating that. So just be very careful with that. Take everyone's opinions, but it's an important opinion. It's important to consider all that.
And the last thing I would just add to that, I mean, certainly, and you always want to have your risk management covered. The one thing I think we're all aware, but it just bears to be said at this point, is that there's no such thing as the real estate market. There's thousands of markets broken down by size, type, location, all these things, right? So certainly, if you have a multifamily in Seattle or San Francisco, you're getting smashed. If you're in Tampa, you're crushing it. So look at supply and demand. At the end of the day, price is always supply and demand. So apartments that have more demand are still going to go up, and apartments that have less demand will go down. So just keep that in mind when you think about that.
And I want to add to Mark's thing, and then yes, Bronson, I'll give it back to you. I want to add to Mark's point,
This is a lively panel here.
You have no control. What I want to add to Mark's point is he's completely accurate. I agree 1,000% with what you just said, or 100% with what he just said, absolutely. Because not only is it regional, but also it is by asset. And also, people constantly ask, well, what's the black swan event? What's going to happen? Well, what about single family? What about multifamily? What about office? What about commercial? Do not for a moment think that the real estate market moves as a single whole. It doesn't, right? When we had COVID, who knew that the single families were going to continue to go up so aggressively? And I guess somebody smarter than me knew that hospitality was going to get slammed. Who knew that office was going to move? So I think that Mark's correct in cautioning, you can't assume just because the data in that niche, in that market, or in that asset class has always done this, that this is what's going to happen. And that's why it's like, you got to stay watching. What is going to be the bloodbath this time? There's going to be something that's going to be hit hard. What is it going to be? So don't be assumptive, but still be observant and use your predictions as best you can and constantly update.
Your Honor, I'd like to object to Christina giving 1,000 points to Mark and 80 points to me.
I agree. Come on, Mark. Here,
Can't give more than 100 points to anybody.
We're going to dress you guys in sumo suits, and you're just going to like go attack each other, and we're going to figure this out. Can we get a mic ready? We're going to do some questions. If you have a question, raise your hand. I had other questions,
We do need to get to the question of what does that mean to us as investors.
Well, no, but we're going to get to questions that you guys took up all the time, and it's great. But let's raise your hand if you have a question. You do have a few new terms to look up. You've got things like yield curve inversion. You've got recession. I think numbnuts was another one. So there's a bunch of terms to look up. So we have a question.
Don't forget idiots.
You got a question here, Esmeralda? Yeah, please go ahead. We got a microphone up here, please.
Good afternoon. My name is Esmeralda Gonzalez. I live 5 minutes away from here. However, it took me 40 minutes. Don't ask me why. This is not a question. It's more an observation. Thank you, everyone, for coming up here. It's very admirable, and I'm humbled by your knowledge. However, Mr.
Bawa.
Bill
Bawa.
Neal.
Numbnuts.
What does that mean?
What does that make me, idiot? You're numbnuts? Okay, great. I'll take it.
You get me nervous.
Congratulations!
Wait, did you say you get me nervous?
You get me nervous, yes.
Okay, I think you said something else.
You get me nervous.
I get grumpy if I'm not fed.
I've gone to some of other summits, conferences, and this is as close as I've gotten to you. However, I did pay attention when you were talking about the apocalypse and the apocalypse.
Yeah, something like that.
But you got me more nervous when you were walking back and forth. Your toes were literally pointing out, and I thought you were going to fall. You got me really nervous.
Come on, I don't think you've really arrived until you've fallen off the stage at least once. So come on.
Sorry, did you have a question, or are you just making a statement? Okay, thank you. Okay, does somebody have a question? Thank you for sharing.
I need one of those kid barriers.
Yeah.
Yeah, this goes back to what you're talking about between fiscal and monetary, whether it's going to be Congress or the Fed. There's a thought out there that it's going to be both, right? Because it boils down to liquidity in the system.
What will be both?
Essentially where the stimulus is going to come from. It's going to come from the monetary side, so the Federal Reserve, right? Easing and essentially eventually pumping liquidity in the system. But also on the fiscal side, right? Like what we saw during COVID, right? Direct checks to people. So even if they're not working together, do you think there's a possibility that they work in tandem but like kind of offset? Does that make sense, right? Like the overall liquidity in the system is going to go up, right? And therefore asset prices are going to go up.
Are you asking a specific person on the panel, or are you asking the panel in general?
I guess, yeah, more Mark, right? Because
Well, I agree with Neal that he said we haven't seen it before, that the Fed and the Treasury would or Congress would kind of commandeer the Fed, if you will. They have before, but I think they will again, and I think they'll work in tandem. As of right now, I believe there's a couple warring factions, and so we kind of look at this world through this strategic lens, which is a deeper conversation. But we are seeing. I'm a Bitcoin guy, and so the biggest objection I've always heard is they will never give up control over money because they won't let Bitcoin succeed. They won't give up control over money. Well, the Fed doesn't want to lose control over the money. The Fed wants to hold on to the dollar. They don't want to give up control to the ECB, to the BOJ, to the BRICS, and so the Fed is trying to maintain the strength of the dollar. And Jerome Powell said yesterday at the event, the fiscal spending, the government spending, they're drunken sailors. No, he didn't say that. But he said the fiscal spending is unsustainable, is what he said. So he's like, hey, you guys are spending way too much. We're trying to protect the dollar, so we're not agreeing with you. So right now there's a fight, but I think they'll come together, they'll commandeer it, if you will, and they'll both have fiscal and monetary stimulus.
I want to add one thing to that. So don't want to repeat what Mark said. I want to build on top of it. I believe that until we come to a worldwide fiscal cliff, which all of us know is inevitable, right? Nobody knows when. The United States can only have shallow recessions. We cannot have deep recessions anymore. That's because deep recessions in the past used to occur because both Congress and the Federal Reserve allowed the cycle to run its course, right? Recessions are useful and
They're not gonna
beneficial
do that anymore.
for the economic cycle. They are normal. We no longer allow them to do that. We disrupt, we cut off that process. Therefore, until the final cliff, right, which I don't think is more than 10 years away for the world, until that final cliff, the United States can only have shallow recessions because we artificially force our way out of it through stimulus.
I agree, and also because we're in a debt-based monetary system. Most people don't really understand what that means, but money is, we say the Fed's printing money, and like, haha, the money printer go burr. That's not really how it works, right? So money is created through debt issuance, and so that means that the dollars are liabilities, and the debt is the asset. Think about that for a second. The debt itself is the asset, and all those assets collateralize other loans. If the collateral drops, all of those loans go away. We're in a highly leveraged, highly collateralized debt-based system. It can't deleverage, or we get the event he's talking about in 10 years, maybe longer, where it eventually comes crashing down.
Okay, I know we have some more questions. We have time for maybe one or two more questions. Let's go, Guido. Yeah.
So we all know a lot has happened with Fed rates, and there's 2 more Fed meetings coming about. My question for each one of you is, if you were a betting person, are we pausing in November, pausing in December, or are we going to take another quarter-point hike on each one of those Fed meetings? What's your thought?
Let's start with Jeremy and Christina. You guys have been very polite over here, and it's been a little intense over there. There's been like punches thrown or something. I don't know what's going on over there. So, yeah, let's start with you.
So I would say 2 things. Number one is, Ken McElroy's presentation earlier today talked about the Fed is doing exactly what it said the entire time, and they haven't changed. And he's 100% true. If you just read what the Fed issued every time, they've done exactly what they've been saying. And so you should expect rates to stay higher for longer, because that's actually what they're saying at the moment. That's a probability thing, right? Nobody knows where it's going, but that's your best guess right now, is to listen to them. The other thing is that if you want to listen to smart people, which are the Wall Street traders, they're saying there is a very small 2% chance they're going to raise rates at the next meeting, but they're saying right now that there's a 65% chance, or 64, depending on what time of the day you look at it, percent chance at the moment that they're going to raise rates at the meeting after that one, before the end of the year. But the problem is that there's so many factors that can change between now and then. So again, if you're just going to go with probability, you should expect one more interest rate increase before the end of the year, but that could change. And that's just objective. It's not even an opinion. It's what all the smartest minds combined believe.
Thanks. Christina?
Ditto. So,
Okay, thank you.
no, I'm afraid Jeremy and I must be looking at the same charts. So, but then again, Jeremy, I did go to his meeting for years, so that is true. So I agree. I think if you look at the chart, if you look at the Fed rate increases, you'll see in the 80s they bopped up and down. Up, down, up, down, up, down. They weren't able to control the inflation that they were obviously trying to grab a hold of. I think they learned their lesson. Since then, they generally hold the rate at, once they pause, they hold it for a minimum of 6 months. And I think they're going to follow the same playbook. I think they're going to hold it for a minimum of 6 months. I think we're going to see at least one more increase, because even though we, the sumo wrestlers up here, see that we're seeing a variety of charts that are moving downwards, I don't know that the Fed is satisfied yet with what they've got, with what they've achieved. And the conversation of the Fed doesn't want to overshoot, I think, is a euphemism for the fact that they often do. And I think that they will, again, continue to push, because it is a pendulum. They're going to push until something breaks, until they can see something that has broken. And it doesn't have to break by much, but it is going to be something that's going to become obvious to them. And we're now seeing it in the news, that the charts are starting to show that things are potentially going to break, whether it's the banks, whether it's multifamily, whether it's unemployment. So I think we're going to see another increase, probably the end of 2024, the end of 2023, maybe beginning of 2024. And then I think they're going to hold. They're going to hold for 6 months, or they're going to hold for 9 months. Now, I'm going to try to add this in. The advantage of that is, which we're going to get to, what does that mean to you guys as investors, is there is an opportunity coming on your horizon line, right? Was it David who said, look, you can, in 2009, I licked my wounds. I followed the market from 2009 to 2012, and I did not invest, even though I told people in 2012 it's time to invest. Go invest. Be prosperous and invest. And I didn't double down and invest in 2012. Now I'm sitting here going, dude, I'm watching. I'm looking. I'm waiting. I've got a 6 months to about 18 months from now is when I'm looking to understand that this is my time. This is not the not time. This is the time.
So I'm going to pause for a second here. We literally actually
Ran out
this
of
is going
time.
to
I
continue.
used up the
This is going to
last-
continue at the bar, right? Are you guys
I
going to be
used
at the
up the
bar?
last
I want
moment.
you
I
guys.
just want to say one thing, though.
Go, Mark, go.
Okay, Mark, you guys-
I'll
you
restrain
guys-
Bronson,
I
you
may
talk.
have been
30
the
seconds.
only one that watched the Fed meeting yesterday.
Tell
don't
me.
know.
You're right. I did not
Because
watch it. Go ahead. Go ahead.
Jeremy's right. So there is a betting market that tells you what the odds are of the Fed increasing, and I think on Wednesday it was 24%. It got marked down to 5. I saw yesterday maybe it moved down to 2.
No, yeah, it's very low.
Right, so it got super low. First of all, the Fed had only ever paused. The Fed had never paused and raised again until earlier this year. They did, so that's not a historical thing. But what Jerome Powell said yesterday, I think, said it all. So earlier the year, he said the problem is that if we don't go far enough, we would rather go too far and break something because we have the tools to rebuild. Okay, that's what he said before. Yesterday, he said the danger is we go too far and break something. That was a very big shift. Every single word is looked at by a psychologist to figure out what they mean. So that was a massive shift you have to understand. And he said that they think they've done enough. We have 7, in the last 7 days, the last week, 7 Fed board governors came out and said that the market has already made the moves. They don't need to do anymore. He said it yesterday. He said the danger is we've gone too far. So
What does the dot
guys,
chart say?
Thank you so much. I'm going
I
to
still
stand up.
wanna
I know
finish
yes, yes, yeah. So let's give him a hand for a minute. We're going to pause.